Students, today we want to look at accounts receivable write-off. This is under Test 5 material, okay? And if you'll go to Blackboard, like I say, Test 5 material, it's the first set of PowerPoints. We want to pull those up. And this has to do with not paying your accounts receivable or your bill, just like if you didn't pay your credit card. And if you want to go through, you need to kind of sort through some of these PowerPoints. Let's look at the slideshow. There's one example in the PowerPoints talking about CompuSave. There's two methods to write off accounts receivable, which would also be referred to as bad debts, people who don't pay. One is called the direct write-off method. It doesn't involve making an estimate. Somebody doesn't pay, you just write them off. The second one is used by larger public companies called the allowance method. It requires you to do an estimate of those people that you think will not pay you, and then you do that estimate and you record it before you do the write-off. So two methods. The first one, direct write-off, is for smaller companies. The second method is for your large public companies, and it's required by GAAP for them. Okay, the example in the book you can take a look at in the PowerPoints is on a guy named Kent, okay, and him not paying his bill. This one happens to be the direct write-off method, no estimates made. This is the journal entry you would make. You would debit bad debt expense. You would credit accounts receivable. Now, what I want you to do, though, is as we work through these, I want to pull up another assignment, an in-class assignment, and work through it. It will use this journal entry. Let me do an escape here, and let's go back, because I want you to remember this journal entry. I want to go back to the in-class handout, and the second page of this handout is going to be your homework problem. So let's pull that up, and I want you to print it out or either write out your journal entries or type them up. Follow along with me. This is a fertilizer company, and the second page is Hilton. You could say that's Hilton Hotels. This will be your homework problem. So while we're looking at the PowerPoints, I want you to pull up this in-class problem and let's take a look at it. This is a fertilizer company, and they estimate that there will be $50,000 of accounts receivable that won't be paid, and then there's going to be a guy in here who doesn't pay his account. And what is that guy's name? $4,500 worth. Jake Palmer is his name. So what we have here is, under the direct write-off method, first, what do you do about this estimate? $4,500 is the estimate that the company makes of all of their accounts receivable, okay? And Jake Palmer didn't pay $1,500 of that. So let's look again at our numbers. Their accounts receivable, $50,000, okay, hadn't been paid yet. Of that $50,000, they estimate $4,500 will not be paid, and Jake Palmer specifically did not pay his $1,500. So we want to print this out, and we want to do the journal entry for both of them. Now, as we go back to this PowerPoint, I want you to notice that in the PowerPoint, under the direct write-off, there is no journal entry for the estimate, okay? The only entry is when somebody cannot pay their debt. So this is another problem, but the journal entry will be the same. So you want to debit bad debt expense and credit accounts receivable, and then put his name underneath. This is going to be Jake Palmer. There's something called a subsidiary ledger, which is a ledger that keeps up with all the different people who owe money, and his name would be in that. So let's go down to the homework problem and get this one done. Okay. Now, I'm going to put up at the top here direct write-off, okay? Now, when it says the bit about the estimate up here, the $4,500, what I want you to do is I want you to tell me, that's going to be January 1st, do not record estimate. Okay, so for A, you do not want to record an estimate. But on December the 1st, when Jake Palmer cannot write off his account or pay his account, we want to show that. So the journal entry then, 12/31, we want to debit an account called bad debt expense. And then we want to get rid of his accounts receivable. Remember, accounts receivable is an asset. Normally it's a debit balance. Okay, but we want to credit it. And then you want to put his name by the side of it. Okay. And the amount is going to be for the $1,500 here in B. So we're doing B there. We're writing off his account, work backwards, zeros or a dash here for the cents. And we're looking at $1,500. And this is to record the write-off. So companies write it off. It appears on for you as bad credit. Okay, your FICO score, which is the rating score to go and borrow more money when you want another credit card or something. This will be showing there that you didn't pay them, and the likelihood of you getting another credit card or a loan is reduced when you don't pay your bills. But the company is writing it off. This becomes an expense on the income statement. Okay. And you have credited accounts receivable. So what happened here is you had an accounts receivable that had $50,000 in it. And what you just did is to write Jake off. And then there's a subsidiary ledger that has his name, and it shows that he owed $1,500. So in that ledger, what you're doing is you're showing that he doesn't owe it anymore, but again, it goes on his credit score, so it doesn't look good for him. Now, let's go back to the PowerPoints because there is another method. Okay, the other method is called the allowance method. You record the estimate. Companies go back and they do an estimate of how many accounts won't be paid, and then they record that first at the beginning of the year, and then as people don't pay, they come back and they write them off. Okay, this follows the matching principle. Okay, and it shows accounts receivable at what we call realizable value. Okay, so I'll show you about that. Here are the journal entries. Now, this first one is going to be for the this is going to be for the estimate, and this is a different problem for the one we're working. So what we want to do first is we want to go back to our problem. You can review this one yourself, but we want to show the estimate. Okay, so let's go back to the problem. And it says, again, we want to prepare this under the allowance method. And the allowance method is for large companies, public companies, sell their stock. And this follows generally accepted accounting principles, specifically the matching principle. So let's record that. Now come down here to 2. We want to do the estimate. This is going to be on January the 1st. And what you're going to do is you're going to start by doing an expense called bad debt expense. And the amount of the estimate again was $4,500. And you want to credit a new account called allowance for doubtful accounts. Okay, and this is to record the estimate. Now the expense goes on the income statement. It reduces net income. This account is called a contra asset account. Okay, it goes against the balance of accounts receivable. Okay, it's a contra asset account. So what happens, and this is on the balance sheet, I'm going to come down here and show you. On the balance sheet, you'd show this. You would have accounts receivable, $50,000, and then you would have less the allowance for doubtful accounts, and you would subtract that. That's going to give you something called net realizable value. That's my dog over here. Okay, so the net realizable value that would show is $45,500. That's the amount they think they can collect. Now, let's come back, because now we have Jake who didn't pay, and he didn't pay by the end of the year, so we're going to write him off. Okay, we're going to write him off. So 12/31. Now what we have to do now is we want to adjust this allowance account, okay? Because what we're going to have is a credit actually it's a debit here, but we're going against the normal balance. The contra asset has a credit balance. This is going to reduce that. And we are going to write his account off, accounts receivable, Jake Palmer. And this is to write off Jake. Okay, now let's take a look at that allowance account. In fact, let's take a look at both of them. Here's accounts receivable. Here's the allowance. The accounts receivable had a $50,000 amount in it. If you post this $1,500, it's going to reduce that. And so now he would have a balance of $48,500 in accounts receivable. The allowance, we had a credit of $4,500. And we just debited or reduced it. So now you have a balance of $3,000. Okay. Now let's use these balances and see what happens on the balance sheet. Now instead of showing these numbers, okay, this is before the write-off. You want to show the adjusted numbers after the write-off here. So accounts receivable would be $48,500, and then we have an allowance amount of $3,000. Okay. Now I want you to notice what happens. The net realizable value did not change at all. You're still showing the same thing. It's just that now you've adjusted some numbers after the write-off. You've just juggled some numbers reduce some balances in accounts receivable and in the allowance account, you still have the same ending balance for the net realizable value. Okay. Now, there's only 4 entries to the homework, and there's in the direct write-off, you won't do a journal entry for the estimate. Okay. Now let's go back to your PowerPoints. Let's take a look. We were stuck here on the allowance. This was to record the estimate. You look through these. This is a different problem. They're showing you the net realizable value before the write-off. Then we came through, and this is the write-off on J. Kent, if you follow this problem. And they're showing you that the net realizable value is the same, just like I did. 2 totally different problems. The one on the PowerPoint is different from the one in the handout. Okay. You do need to know that the allowance method is required by GAAP for large companies. It follows the matching principle, and you use it if it's a material amount in writing it off. Okay. What's material for Microsoft? Let me back up. What's material for a small mom and pop store is not material for Microsoft. So it depends on the size of the company as to what numbers are material. Okay. Direct write-off does not match sales and expenses. Okay. It doesn't follow the matching principle. This is the example we just did. Okay. Here are the journal entries. Okay. Your homework is this last page. I also have it under the assignment tabs, okay, and it's also on Blackboard. This will be due on Wednesday because I want to come back and show you on Wednesday how companies get that estimate. So let's go back to where you can find your homework. Okay, the second page of this handout that I had pulled up was going to be your homework page, so you can download it. Let's see if it's here. Download, here it is. You can either download it, and it's going to be the Hilton problem. You can write it out like I just did, take a picture and upload it, or you can go to the assignment tab. Let's go over here to your assignment tab. Not assessments, but assignments. Okay, and homework on writing off bad debts is right here. Okay, and the instructions are there. Same problem. This is due Wednesday by midnight. Please note that. So you can either write it in submission link here if you want to type it in, or you can go through and do an upload of your picture. Okay, and your homework assignment. Either way, it's due on Wednesday, so make sure you don't miss that deadline Wednesday, and we're going to pick up another topic on Wednesday also, calculating that allowance. Okay, have a good day. Bye.